Sweeping tax rules are hitting Germany, shaking up capital gains, R&D perks, and even how you get a tax bill. Welcome to another episode of Regtalks. Join us as we unpack what's at stake.
It's wild. Honestly, the German government just dropped their draft annual tax act for 2026, and it's more than a tweak. I'm here with you today to pull apart what's in this package and why business owners, investors, and even everyday taxpayers should pay attention.
We'll break down the big changes, from international tax standards hitting home to what happens if you sell shares or license a photo. Plus, we'll shed light on new electronic notifications, bigger R&D allowances, and what's changing for VAT groups.
If you want clarity on Germany's 2026 tax future and how it could ripple beyond, stick around. We'll guide you through the key beats and flag the practical impact for different players.
Let's start big. One headline is Germany's move to plug into the OECD's global minimum tax, specifically the so-called side-by-side approach. What's actually changing here?
The German Minimum Tax Act is being amended to align with this OECD framework, so Germany can use its own rules as long as the tax outcome matches the global minimum. That means less gaming the system multinationals have to pay at least a set minimum wherever they operate.
So if I'm a global company, I can't shuffle profits around just because local rules differ. The effect has to meet that minimum threshold.
Exactly. And Germany's also giving itself legal muscle to make further adjustments on the fly. So, if the OECD tweaks the standard, Germany can respond faster. It's a big statement on international cooperation and closing loopholes that let profits escape taxation.
That's a good pivot to the next headline. Capital gains relief is getting tighter for big shareholders, especially foreigners. What's the new hurdle?
Before, if you owned at least 10% of a German firm, you could get an advance exemption to avoid withholding tax on capital gains, a system ripe for abuse. Now, you have to apply for a refund after each deal, so tax authorities can check for dodgy behavior before money leaves the country.
That's going to slow things down, but probably means fewer loopholes for creative tax planning. On the flip side, licensing gets a little easier.
Right. The license payment exemption jumps from €10,000 to €100,000. So if you're, say, a publisher paying for rights to a foreign image, you don't need to jump through hoops for small payments anymore, though the tax office can still audit you if something looks off.
You mentioned earlier tax notifications are moving online by default starting 2027. How's that changing the day-to-day for taxpayers?
If you have an Elster account, Germany's online tax portal, you'll now get official tax assessments and appeal decisions electronically. No extra consent needed. Just an email ping, and your docs sit in your Elster inbox.
So, it's more efficient, but people who aren't online get paper as usual. And, if you want to opt back to snail mail, you still can, but you need to ask for it.
Exactly. Plus, Germany's platform reporting is expanding. Platforms must now report income from providers in countries with tax agreements, not just inside Europe. That's a real step toward global transparency on online income.
There's more. Let's talk money mechanics. Tax interest rates are going up, right? That could sting for some.
Absolutely. The rate for tax arrears and refunds doubles to 0.3% a month, or 3.6% annually. It lines up with rising base rates, but if you're late paying taxes, that's a bigger bite.
Businesses in R&D catch a break, though. The new cap is €25 million per company and project, and you're not penalized if your certification process drags on.
Plus, VAT groups now require an active opt-in. Companies have to declare which subsidiaries are in the group, making it more deliberate and hopefully reducing accidental inclusion or disputes.
All these changes sound set in stone, but the process isn't over. What hurdles remain before these rules land in the real world?
The draft annual tax act now heads to the German Parliament and the Federal Council for debate and approval. There could be amendments. The politics can get lively when it comes to taxes, so watching for tweaks is important.
So, we might see parts of the package shift before it's law. Until then, taxpayers and businesses should keep an eye on developments and maybe start prepping for likely changes.
Exactly, especially for things like the electronic notifications, or if you're affected by the new R&D or VAT rules. It's better to anticipate than scramble once the ink is dry.
Let's wrap it up. First big takeaway. Germany's aligning its tax rules with global standards, which will hit multinationals and cross-border firms most.
Second, capital gains and licensing rules are shifting stricter on abuse, easier on routine deals, while R&D and VAT groups see more flexibility.
And third, the digital push is real. Electronic tax notifications are the new normal, with more income reporting across borders.
If you do one thing next, check your Elster setup and review your company's capital gains or licensing flows. It's time to prep for what might be a very different tax landscape in 2027.